3 days ago, while markets opened and closed as usual, and while analysts debated basis points and inflation data, the most powerful monetary authorities in the United States were not on television. They were not giving speeches. They were locked behind closed doors in Wyoming, 14 hours, no press, no public record. What came out of that room was not confidence, it was capitulation. For the first time since Nixon closed the gold window in 1971, the Federal Reserve has formally acknowledged the dollar system is failing. And they've turned to something nobody saw coming. 500 million ounces, 12 months, $267 per ounce. The buying has already begun, and the market has no idea. Welcome to Currency Forensics. If you've spent decades watching markets, if you remember when financial news required patience and a newspaper, if you understand that real wealth is not built on hype, but on information others do not have yet, then you know the value of what you're about to hear. Do me a favor, one professional to another, hit that subscribe button. Not because I'm asking, but because the next 12 months will rewrite how precious metals are priced, and you'll want to know before the headlines tell you it's already too late. Now, tell me in the comments, where are you watching this from? London, Singapore, New York, Mumbai? Because what happens next affects every currency, every market, and every person holding wealth in paper promises. Let's begin. On January 5th, 2026, something happened that most people will never hear about. While traders watched screens, while investors checked portfolios, while the world moved through another ordinary Sunday, the Federal Reserve was holding a meeting that wasn't supposed to exist. Not in Washington, not in a boardroom with cameras and microphones. In Jackson Hole, Wyoming, 12 Federal Reserve Bank presidents arrived quietly. The Board of Governors followed, senior Treasury officials, representatives from the National Security Council. 14 hours behind closed doors, no press conference after, no official statement, no public record of what was discussed. This was not normal. Jackson Hole is famous in financial circles. It's where the Federal Reserve signals major policy changes. Quantitative easing was introduced there. Emergency measures were announced there. But those were public events, conferences with academics and journalists and carefully prepared speeches. This was different. This was an emergency summit. And emergency summits only happen when something is broken. The last time the Fed moved like this was March 2020, when the pandemic threatened to collapse the financial system. Before that, September 2008, when Lehman Brothers fell and credit markets froze, those meetings saved the system, but they also revealed something important. When the most powerful financial institution in the world gathers in secret, it's because the tools they normally use are no longer enough. What came out of that room in Wyoming was a document, 73 pages, confidential, internal use only. The title was bureaucratic enough to sound boring. Emergency policy options for dollar system stabilization and strategic reserve diversification. But buried inside those pages was a program with a name that mattered. Operation Silver Shield. The United States government had made a decision. They were going to build a strategic silver reserve. Not a small one, not symbolic. 500 million ounces to be acquired over 12 months. And according to the Federal Reserve's own economic models, once that buying began, silver would not stay at $30 per ounce. It would not stop at 50 or 80 or 100. Their calculated equilibrium price was $267. That number wasn't a guess. It wasn't marketing. It was mathematics. Based on global supply constraints, industrial demand that cannot be reduced, and the impact of a buyer who does not care about cost. The Federal Reserve had run the scenarios. They knew what would happen, and they decided to do it anyway. Because as of January 2026, the alternative was worse for the first time since 1971. Since Richard Nixon severed the dollar from gold, the Federal Reserve had acknowledged in writing that the system built over the last 50 years was no longer viable. The dollar was losing its dominance. The debt had become unsustainable. And America's adversaries had already moved first, so they turned to silver. Not because it was easy, but because it was the only move left. And here's what makes this moment different from every other financial story. The buying had already started. January 7th, 2026, 2 days after the meeting. While silver traded quietly near $32, while analysts called it a boring industrial metal, and while investors ignored it for Bitcoin and AI stocks, the Federal Reserve was already in the market, quietly through intermediaries, locking in supply before anyone noticed. The repricing hadn't happened yet, but the decision had already been made. The question wasn't whether silver would reach $267. The question was how fast it would get there, and who would be positioned when it did. Before understanding what the Federal Reserve decided to do, one must understand why they had no choice. This wasn't about opportunity. It wasn't about getting ahead of a trend. This was about survival. 3 separate crises had been building for years, each one serious enough on its own, but manageable, containable, solvable with the right policy tools. Then something changed. They stopped being separate. They converged all at once. And when that happened, every conventional solution disappeared. The first crisis arrived quietly. It didn't announce itself with a market crash or banking failure. It showed up in spreadsheets, in trade settlement data that most people never look at. The dollar's share of global transactions had been falling. In 2020, 63% of international trade was settled in US dollars. By early 2026, 47%. That's not a slow drift, that's a cliff. And the speed was accelerating. In 2025 alone, the dollar lost 8 percentage points. 8 in 1 year. At that pace, the dollar would no longer be the majority currency for global trade before 2030. Most people don't understand what that means. They think reserve currency status is about prestige, about being number one. It's not. It's about permission. When the world uses your currency, you can print money and export the inflation. You can run deficits that would destroy other nations. You can borrow endlessly because everyone needs your currency to function. But when that status fades, the inflation comes home, the deficits become unbearable, the debt becomes a noose. Inside the Federal Reserve's internal documents, the language was blunt. The currency war is being lost. China wasn't playing defense anymore. They were winning. And the Fed needed a fallback position. Gold would have been the obvious choice. Except China and Russia had spent 20 years stockpiling it. Entering that market now would be an admission that they had been right all along. The second crisis was mathematical. $36 trillion in national debt, $1.2 trillion in annual interest payments, more than defense, more than Medicare, more than any single budget item except the debt itself. And the curve was accelerating. The Congressional Budget Office had run the projections. By 2029, interest payments would exceed total federal tax revenue. Think about that. Every dollar collected in taxes, gone. Just to service existing debt, not to build roads, not to fund programs, just to pay interest on money already spent. At that point, borrowing to pay interest isn't a risk. It's the baseline. That's the definition of insolvency. The Fed had two options: monetize the debt, print money to cover it, trigger severe inflation, or refuse and trigger default. Neither option preserved the system. So inside that Wyoming conference room, they discussed a third option: preparing tangible assets now for whatever comes after the dollar. The document literally had a section titled Post-Dollar Monetary Architecture. They weren't guessing about the future. They were planning for it. The third crisis was the one that forced immediate action. In December 2025, China banned all refined silver exports. Not temporarily, not with exceptions, completely. And according to U.S. intelligence assessments, China now controlled 2.1 billion ounces of silver. 5 years of global production, accumulated quietly through state-owned enterprises, sovereign funds, proxy buyers operating in shadows. The impact hit American industry immediately. Electronics manufacturers faced longer lead times. Solar panel producers saw a premium spike. Electric vehicle companies scrambled for supply. Defense contractors flagged critical shortages. Silver isn't optional in these industries. It's not a preference. It's embedded in the physics. Best conductor, most reflective, most reliable. You can't substitute it in most applications without fundamental redesign. And redesign takes years, not weeks. The National Security Council's conclusion was direct. If this continues, China gains control over critical American supply chains without firing a single shot. 3 crises, currency collapse, debt insolvency. Strategic resource control. Each one would have been manageable alone. Together, they eliminated every conventional response. Rate adjustments couldn't fix de-dollarization. Liquidity injections couldn't solve the debt spiral. Monetary policy couldn't counter China's resource strategy. And the Fed needed something different, something physical, something strategic, something their adversaries didn't control yet. They chose silver, and the decision was already in motion. Inside the 73-page document, there was a section that changed everything. Page 41. The heading read simply, Asset Selection Rationale. What followed wasn't speculation. It wasn't theory. It was cold calculation. The Federal Reserve had analyzed every possible hard asset: gold, platinum, rare earths, even copper. They had run models on each one, examined supply chains, evaluated strategic positioning, calculated geopolitical risk, and then they made a choice that surprised even the people in that room. Not gold, silver. The gold problem was simple. Everyone already knew gold was important. Central banks had been buying it for decades. Russia accumulated thousands of tons. China did the same. India, Turkey, Poland. The global gold rush had already happened, and America was late. If the United States suddenly entered the gold market aggressively, prices would explode immediately. But more importantly, it would validate every move China and Russia had made. It would tell the world they were right, we were wrong. That political cost was too high. Beyond that, gold had become a crowded trade, a market where adversaries held dominant positions. The Fed would be buying into strength, competing against nations who had prepared for exactly this moment. No strategic advantage, no leverage, just late entry into a game others had been playing for 20 years. Gold was the expected move, which made it the wrong move. Silver was different. Silver sat at an intersection nobody else was watching. It wasn't just a monetary metal, it was a necessity. The document spelled it out clearly. Silver represents dual strategic value, monetary reserve function combined with irreplaceable industrial utility. 420 million ounces. That's how much silver American industry consumes every year. Solar panels require it. Electric vehicles need it. Advanced electronics depend on it. Military systems can't function without it. And 60% of that supply, imported from Mexico, from Peru, from China. That dependency was a vulnerability. China had already proven silver could be weaponized. Their export ban in December 2025 sent immediate shockwaves through American manufacturing. Lead times doubled, premiums spiked, supply chains strained. Companies that assumed silver would always be available suddenly couldn't get it. The Fed's conclusion was direct. Silver is not optional demand driven by sentiment. It is embedded demand driven by physics. You can choose not to buy gold. You cannot choose not to use silver. If you want solar panels that work, if you want electronics that conduct properly, if you want defense systems that function reliably, then came the supply analysis. This was where the math became unavoidable. Global investable silver supply, the silver actually available for purchase outside long-term industrial contracts, approximately 300 million ounces per year. The Fed's target, 500 million ounces, more than an entire year's accessible supply. That silver had to come from somewhere. ETF vaults, private collections, forward contracts with miners, metal that hadn't even been dug from the ground yet, and none of it would come cheap. The economists modeling this understood basic supply and demand. When a buyer enters the market seeking more than total annual supply, price doesn't adjust gradually, it spikes. They ran 3 scenarios. Conservative case. Existing holders sell enough to offset government buying. Price tops out around $170, but the report itself flagged this as unrealistic. It assumed no psychological response, no panic, no copycat behavior from other nations. In real markets, that assumption never survives. Moderate case. Other countries notice what America is doing. Saudi Arabia allocates capital. Japan follows. South Korea enters. Total sovereign buying reaches 800 million ounces. Price moves into the low 230s. More realistic, but still conservative. Then came the third scenario, the one the Fed actually believed would happen, the aggressive case. This was where human behavior entered the equation. Once the United States government publicly declares silver as strategic material, perception changes instantly. Retail investors pile in, dealers run out of inventory. Industrial users start hoarding because nobody wants to be the company that runs short. Demand doesn't just rise, it explodes. Total demand in this scenario, 1.2 billion ounces. Against annual production of 850 million. A deficit that large doesn't resolve peacefully. Price has to rise far enough to destroy marginal demand and pull every hidden ounce into the market. The Federal Reserve's model calculated exactly where that happens. $267 per ounce. Not a guess. Not a target they chose. The price where supply and demand mathematically balance. When the largest buyer in history enters a constrained market. That number sat on page 58, buried in a table, labeled simply equilibrium price under scenario 3A. The people in that room knew what it meant. Silver wouldn't climb slowly, it would launch, and there was no way to avoid it. Because the alternative, doing nothing, meant surrendering strategic control to China, meant accepting dollar collapse without preparation, meant watching American industry struggle for supply while adversaries controlled access. Operation Silver Shield wasn't about making money, it was about survival. 500 million ounces, 12 months, $267. The decision was made, and the clock was already running. January 7th, 2026, 2 days after the Jackson Hole meeting. Silver opened at $32.18. Volume was normal. Price action was boring. Analysts weren't watching it. Investors weren't talking about it. The market looked exactly like it had for months. Quiet, predictable, forgettable. But something had changed, something invisible. Somewhere in that market, hidden among the usual buyers and sellers, the United States government had entered, not loudly, not obviously, through channels most traders would never recognize. The Treasury's Exchange Stabilization Fund, a mechanism created in 1934, designed for exactly this kind of operation. Proxy buyers with no clear connection to Washington, intermediaries working through private banks, forward contracts negotiated directly with mining companies, deals structured to lock in today's prices. for metal that wouldn't be delivered for months. This was phase one, stealth accumulation, the quiet window, the period that only exists before markets realize what's happening. The strategy was precise. Target, 150 to 200 million ounces. Time frame, January through March. Methodology, avoid triggering algorithmic alerts or unusual volume patterns. The Fed understood something fundamental. Markets move on information, but they move faster on surprise if accumulation happened gradually, if each purchase looked like normal commercial activity. If no single transaction raised flags, they could secure a third of their target before anyone noticed. Mining companies received quiet visits, senior executives, private meetings. The message was simple. The United States government wants to purchase your forward production, not at market price, at a premium, 10% above spot, locked in for 12 months, guaranteed payment, no questions asked. For a mining company, this was the deal of a lifetime, price certainty in an uncertain market, a buyer who would never default, immediate capital for expansion. They signed, one after another, Chile, Mexico, Peru, Australia, contracts for millions of ounces, metal still underground, already sold to a buyer the market didn't know existed. Refineries got similar offers. Vault operators received inquiries. Large holders were approached discreetly. Would they consider selling at above market prices with confidentiality agreements attached? Many would, because $35 per ounce, when the current price is $32, looks like smart business. What they didn't know was who was buying or why. By late January, the Federal Reserve had quietly secured approximately 60 million ounces through forwards, through private sales, through inventory purchases nobody reported. The cost, roughly $2 billion, barely noticeable in a government that spends trillions. And the market hadn't moved. Silver still traded in the low 30s. Volatility remained low. Open interest on futures was normal. ETF inventories showed modest outflows. Nothing unusual. Everything looked fine. But beneath the surface, available supply was shrinking. Refineries had less metal in storage. Mining companies had sold production they hadn't extracted yet. Vault inventories were lower than reported levels suggested. The spring was coiling, and nobody saw it. Then came the problem. Secrecy has a shelf life. Legal requirements don't care about strategy. Congressional oversight committees had to be briefed. Treasury reports had to be filed. Government accountability offices would eventually audit the transactions. The quiet phase couldn't last forever. The Fed knew this. Their internal timeline assumed disclosure by mid-March, maybe early April if they were lucky. After that, everything changed. Phase 2 was different. Phase 2 was public. It began with a statement, carefully worded. Released on a Friday afternoon when markets were closing, the language would be bureaucratic, technical enough to sound boring, but clear enough that professionals would understand. In response to evolving supply chain vulnerabilities and strategic reserve diversification objectives, the United States Treasury, in coordination with the Federal Reserve, is initiating the development of a strategic silver reserve. No specific numbers in the first paragraph. Those would come later, buried in supplementary materials. 500 million ounces, 12-month completion target. Estimated allocation, $21 billion. That last number was a lie. The Fed knew it. $21 billion assumed an average price of $42, but their own models showed that price wouldn't exist, not once buying became public. They were prepared to spend $50 billion, maybe more. Cost was secondary. Completion was the objective. Markets don't wait for explanations. The statement would hit terminals at 4:47 p.m. Eastern. By 4:48, silver futures would be limit up. By Monday morning, chaos. Retail investors flooding into ETFs, sovereign wealth funds calling emergency meetings, industrial users panicking about future supply, dealers reporting inventory shortages within hours. The price wouldn't climb, it would explode. $40 by the end of the first week, $60 by the end of the month, $100 by late April. Not because of manipulation, because of mathematics. When available supply is 300 million ounces per year, and demand suddenly jumps to 1.2 billion, price becomes the only mechanism to balance the equation. By June, silver would be trading above $200. The Federal Reserve would have secured 300 million ounces, more than half the target. But the easy part would be over, July through December. The final 200 million ounces would cost more than everything before it, because by then, everyone would understand what was happening. The last holders would demand premium prices. Miners would renegotiate contracts. Nations would compete for remaining supply. And through it all, the Fed would keep buying. 220, 250, 270, whatever the price, whatever the cost, until 500 million ounces sat in strategic storage, removed from circulation permanently. The timeline was set. January, quiet accumulation. March, public revelation. June, halfway complete. December, mission accomplished. And a new price, equilibrium, $267. Not the top, the floor. Because once 500 million ounces disappeared from the market, industrial demand would still exist. Solar installations would still need silver. Electronics would still require it. But supply would be permanently reduced. The deficit wouldn't be temporary, it would be structural. Prices wouldn't collapse after the Fed stopped buying. They would stabilize at the level where supply and demand could balance. With 500 million ounces gone forever, the market just didn't know it yet, but it would, soon.